Okay, this is a video, and it's the first one of probably several that's going to look at this problem. It should be in your file, your folder. And the problem has an 80-20 split, and you'll notice at the bottom we're going to do both the acquisition year and the end of the year. And it turns out this also has a control premium or penalty. 1 year A parent acquires 80% of the outstanding stock of a sub paying $1,570,000. And then the parent estimates that at the date of purchase, the market price of the remaining 20% is $380,000. So that means the total value of the subsidiary, $1,950,000. Then it's given that the book value of the total assets is $1 million. So that means that the excess is $950,000. There's also a couple of identifiable assets that are unrecognized or undervalued. So property, plant, and equipment, 50 years, it's undervalued by $500,000, and the unrecognized intangibles, 10 years for $30,000. So let's start with our first piece of prep work, and we're going to do at least year A and year B. I think we only need year A. We've got the property, plant, and equipment. It has, if you go back to the problem, a $500,000 undervalue, so we're going to be adding that to our balance sheet. And the impact of that on our income statement, 50 years, that seems a bit much, but anyway, is $10,000 per year. That means each year we'll have a reduction of $10,000. We also have those intangibles that when we start looking around, we find for $300,000. And they're going to be adding expenses of $30,000. So each year we're going to have an additional amount of expenses, $40,000. Now the next thing we need to do in this problem, and I know that the material's a bit out of order because it's got the consolidation worksheet there, but I want to go down and do goodwill. That's really going to be important in these kinds of problems. So the important thing about the goodwill is that we're now going to work kind of backwards. We know that for the 80%, the parent paid $1,570,000. We also know that at that time they estimated the value of the sub to be $380,000. If we add those together, it means the total value, had there been a purchase of everything, given the information we know, is $1,950,000. So that's the purchase price. Let me slide that down. There we go. The book value the problem gives us for the entire asset is $1 million for the entire company. And of course 80% of that would be $800,000, sorry, and 20% $200,000. Leaving us with an excess of $950,000 for the entire subsidiary, $770,000 and then $180,000. Now the additional items for write up to fair market value in this case, we have them right over here. The $500,000 and the $300,000. I'm going to subtract these just to show that we would normally be subtracting the fair market value purchased. And we subtracted in two pieces, the book value that was subtracted up here, and here are these two extras, and that's going to give us goodwill of that's not right. Oh, 300,000. That's wrong. There we go, 150. So now we have to go and divide these two up among the 80% and the 20%. And over here, the 20%. Now we can find each section of ownership and their goodwill. So the 80% has a goodwill of 130, and the remainder is 20,000. Now, what percentage is this? 130 as a percentage of 150 is 87%, and 20,000 as a percentage of 150 is 13%. So whenever we deal with goodwill, we're going to be using that 87-13 percentage, not the 80-20. All right. Is that going to affect this first set of entries that we make on the consolidation date, the acquisition date? Well, we'll have to see. So the first thing that we want to do is to eliminate the duplicate shareholders' equity. So let's go down here. We have some common stock, we have some additional paid-in capital, and we have some retained earnings. I'm going to debit those to eliminate them. Here's the amount. Do we worry about beginning of the year? Well, these are all at beginning of the year. So this retained earnings is already at beginning of the year because this is the date of acquisition. Now there's no goodwill involved in that, so we're just going to take out of the investment the 80% or the controlling percentage. And I'm going to just sum up the equity, which by the way is $1 million. We already know that. And this is the non-controlling portion, the remaining 20%. Now we have to do the restatement or the reclassification for the two increases, property, plant, and equipment, the intangibles, and that troublesome goodwill. This has to be the full 500,000. This is 300,000. And this is the entire amount that we just calculated down here, 150. But we now have to divide them between that equity investment that the 80% of the parent owns and the non-controlling portion. But we cannot just use the 80%, 20%. Instead, we're going to take the 500,000 and multiply that times 80%. plus we're going to take 80% times that 300,000. But when we get down to the goodwill, we're going to take the 87%. That's less than we might have expected, or more. And we're going to sum those up. And that is going to be the amount that I am going to credit here. So this is the amount that's going to the parent or the majority controlling interest. And here's the non-controlling. We know they get 20%. But here they only get this 13%. $180. Now you can go ahead and apply these into the consolidated portion, and I will post the answer. But the big lesson here is that when we have a control premium, that will change the allocation of anything having to do with goodwill.